All right. Hey guys, last week budget 2024 came out and one of the biggest changes was about the capital gains inclusion rate. So we're going to talk about that increase and how that's going to affect people and who that is most likely going to affect, which probably isn't you. Okay, so like I said, last week there was some budget changes to the capital gains inclusion rate for people that make a capital gain in excess of $250,000 or make capital gains within their company. Now, I had put this video out last week, but I made a mistake. I misread something and my calculations were off, and it's too bad that I had to put that video down because we were getting tons of comments telling me how stupid I was. So I wish I could have kept it because it was getting a lot of engagement, probably would have got a lot of views, but I made a mistake and I'm human. I apologize for that. So like I said, we're going to mostly talk about individuals today and who this is going to affect, which, as far as the government has suggested, is about 0.13 of the percentage of the population. I think that that number is going to be a little bit higher. However, I mean, it is still a low number. So what this means is that if you have a capital gain in excess of $250,000, before you used to pay an inclusion rate of 50% on the entire capital gain. Now you have to pay 66.7% on everything above the 250,000. But it isn't 66.7% tax. You are taxed on 66.7% above 250,000 and 50% on 250,000. So with like a $250,000 capital gain, that means you're taxed on $125,000 worth of income. Hope that makes sense. If you had a capital gain that was 350, then you'd have to pay tax on 125 plus $66,700 on top of that. Hope that makes sense. Who is this really going to affect? This is only really going to affect individuals that are dealing in real estate, have, a rental property that's gone up big in value, owned a family cottage that has gone up a lot in value. Most people that have stock portfolios that have unrealized gains of in excess of 250,000, you can structure the selling and buying of new ones so that you aren't going in excess of the 250,000. But with real estate, it's always a one-time transaction, all happens at once. So you need to think about the timing because your taxes are going to increase. What I'm going to talk about at the end is an example of a family cottage that has grown for 40 years, and when it sells, there's going to be a big capital gain on that. But as far as like stock planning, it should be pretty easy. Now with small businesses, this is going to impact small businesses and their capital gains in most cases, but not small business, because I'm going to talk about that in a second. So you're always going to pay more tax. And what the government has wanted to do and been trying to do for many years now is trying to sort of penalize small business owners from keeping assets in their company. They're wanting them to pay taxes to get it out personally, so they're making you pay more tax inside the company on your gains, dividends, things like that. So, however, what they have done is they've increased the lifetime capital gains exemption for small businesses from $1,016,000 to 1.25 million. So if you started a business and you grew it to 1.25 million, now you can sell that absolutely tax-free. That's money in your pocket as a small business owner, as the shareholder of that business. One of these days, I'm going to look at Master Yoda himself, built a spreadsheet. That's Jason Watt. He's basically taught every financial planner in the country, knows more than all of us. He built a spreadsheet showing, okay, how is this going to impact you with the increase in the lifetime capital gains exemption and the increase in capital gains inclusion rate. So, like I said, this is mostly going to impact people with cottages and some estate planning. So we did the video a couple weeks ago about how your estate is taxed. This is going to change. It's wrong now because those numbers are different. But you can go back and watch that and then just sort of use that as an example. So what you can do is pre-plan sort of how your estate's going to work so that you can reduce the taxes, you know, now or later. So there is some planning that can go along with this for sure. Let's get into this example. All right, so we're gonna get into an example of a cabin that's been in a family for a long time, a cottage that has been in a family for a long time. This is always sort of the most complicated estate planning stuff you get on an individual level because there's so much emotion, there's tax, there's everything. There's a lot going into multi-generational cabins. So this is just the tip of the iceberg. This is just telling you the tax you owe, but this has nothing to do with the planning of it. So we've got a cabin. Somebody bought it in the 60s for $50,000, and today it's worth $1.1 million. You sell it after all the closing costs, you sell it, you get $1 million. So you have a capital gain of $950,000. On the first $250,000 of that $950,000, you have an inclusion rate of 50%. So you're going to have to pay tax on $125,000. Plus, you've got the remaining $700,000 in the gain that's taxed at an inclusion rate of 66.7%. So you're going to be taxed on $466,900 of that portion for a total of $591,900. Now, if we're assuming a 45% tax rate on that almost $600,000, depending on your province, depending on your other income, it's probably not going to be lower, but it could be higher than 45%. You're going to owe 45% of $591,900, which is $266,355. That is $75,105 more than you would have paid before, or an average tax rate on the capital gain of about 28% compared to 20%. So, you know, you're still left with a good chunk of change, $733,645, but it certainly is an increase when there is a substantial capital gain. So there are some options that you can think about to, you know, reduce these. Timing of the sale. You can change your primary residence because your primary residence exemption, you don't have to pay capital gains on, you know, the sale of your house. So if your cottage has gone up more in value or is going up more in value than your house, you may want to consider shifting that. This could mean there's a tax implication today. There's a lot to it. It's fairly complicated, but something that can come into, you know, planning for sure. With your stocks, you sell them slowly, realize some gains over time. You shouldn't go over that 250 threshold. And then business planning is a whole other ball of wax. And lawyers and accountants and people in my industry that, you know, love moments like this, I guess, because people want to save taxes. So the people that make money are the lawyers, the accountants, and the financial advisors and insurance agents that just take advantage of the situation. So if you want unbiased and planning that you pay for, come to us and we'll try and help you through it. Look at k4financial.ca. Email us anytime. We'd love to hear from you. Thank you very much for watching, and let's go oil.